Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, how's it going? We're back here on Pi Day 314, and I got some interesting stuff in the gas market to talk about. How's it going up in Montana?
Fantastic. I thought we were getting so close to springtime, and then all of the snow started again last night. Yeah. And I guess the true start of spring is about a week away, and I'm ready for it.
Yeah, should be good. We got some snow here as well. So I think we should kick it off with some of the stuff that's going on between Russia, Ukraine, US, quite a few updates there, plenty more to come. But kind of the gist, laying the groundwork, is US, Ukraine met to discuss some ceasefire talks, gave that proposal to Russia. Who knows what ends up happening there? But I think some of the questions in the gas market in the EU is what happens if we reach a successful ceasefire negotiation and we potentially have Russian pipeline gas returning. So I guess that's kind of the very basic intro. What's your kind of initial take on, will we see Russian pipeline gas back into the European Union?
You know, honestly, I'll go back to just the ceasefire. I got a little bit of a problem with the concept of a ceasefire, which leads to the restart of the flow of dollars and or weaponry to one of the sides, obviously Ukraine, in the ceasefire. Mm-hmm. If we got a ceasefire that's moving towards peace, why do you need the dollars and the weapons? I mean, I don't know. Just, yeah, it feels like a little bit of smoke and mirrors to me. Will we see Russian pipeline gas flowing freely into Europe again? Well, it still flows to Europe, really, just not through the Nord Stream pipeline. You know, a circuitous route through the, TANAP pipeline, the Turk Stream pipeline. You know, are there ways to get Russian gas into Europe? Sure. Just like we get Russian LNG into Europe on a boat, maybe with a different sticker on the side. So, I think the path forward is muddy at best on, I guess, the, reinstating what once was in terms of piped Russian gas to Europe. Yeah. And I think the number one point is the immediate, I guess, volley of headlines where there was, I think it was a US-backed entity that proposed to go in and get Nord Stream all shined up and ready to go again. And the first response came from Germany, the country that would most likely be the beneficiary of Nord Stream restarting. Yeah. And, unless the people at the tail end of the pipe want it, it doesn't matter what the rest of the world desires. However, in today's present tariff-laden environment, I don't know. Do we force Germany to take Russian gas via pipe? And who are we to, make such a move? Clearly, when I say we, not you and me. You and I have nothing to do with this, but as
United States
citizens,
yeah. Yeah, I think it's a kind of an interesting question because there seems to be a little bit of a divergence between the beneficiaries of pipeline gas in the eastern half, eastern side of Europe, say Slovakia, Austria, Hungary, Czech Republic, versus Western Europe, who maybe is kind of in the attitude of fool me once, shame on you, fool me twice, shame on me. Seems to be the case for folks like Germany, pushing for, maybe more LNG, but also kind of prolonging some of the activity in Ukraine. And, we'll see how that ends up shaking out, as you said. But I think Russia's response was exactly as you said, that, we're not interested in having a ceasefire that's just a restocking opportunity to prolong this even further. I think one of the interesting ones for Slovakia, though, was that the gas transit agreement that expired with Ukraine on January 1st of this year that really affected Slovakia more than most other European countries. So Slovakia's prime minister has been really pushing for some kind of gas transit agreement. And lately that has looked like, well, if we can't get Russian pipeline gas turned back on, will we get Azerbaijani gas or some other alternative through this pipeline that's already there? One of the other sides of that, though, that I think needs to be discussed is what's happening in the Kursk region. So in the last 2 weeks, Russia has recaptured all of the territory, or nearly all of the territory that Ukraine captured in the Kursk region inside of Russia. And that region is the same location that holds the gas compressor station or pumping station for the, they say, 1.5 BCF a day pipeline that was transporting supplies from Russia through Ukraine into Slovakia. So kind of an interesting trend there. What do you think on the Azerbaijani side? I think before we hopped on, we were talking about some of the new pipeline capacity that's maybe coming into that area.
Yeah, I mean, Russia's not the only, I guess it's not really fair to call Russia Eastern European, but, on that side of the European continent, its friends and neighbors, I use friends and loosely, but neighbors are what they are. There are significant gas deposits. Azerbaijan has been a gas producer for a long time. Turkmenistan has some meaningful gas deposits. And if you haven't ever nerded out, it's fun to just look up the videos of the gates of hell, essentially the fire hole where once upon a time a drilling rig hit some gas deposits that were so close to the surface that it literally fell into the hole, caught on fire. And the thought from engineers at the time was that it would just extinguish itself after some days. And I think it's like 15 years now, maybe 20 years now. It's just a big open burning pit. Wow, so that would say to me, there's probably some gas deposits in the area. And, Azerbaijan in particular, it's rarely a country that comes up in, I guess, coffee table talk about the energy markets globally. But there are, it's a country that is very familiar with oil and gas extraction. It's had a healthy oil and gas industry there for decades. So is there a path to, I guess, do more exploration there, bring more Azerbaijani gas online? And then the interesting wrinkle becomes, well, who funds that? Is it, we've talked a lot about how you may sanction China, but unless you're sanctioning Indonesia, the Philippines, Vietnam, then you're not really sanctioning China. So is there a similar path where Russia, being the energy giant on that side of the world that is not a Middle Eastern country, are they the ones that come in and fund that to, have you take some Azerbaijani gas that has a Russian big brother making it happen?
Yeah, Gazprom investment. Yeah, exactly. It's kind of the same thing with China and Guyana, the 33% share, whatever it is, and the ExxonMobil consortium down there. But the Asia side of that is also an interesting point to bring up with the Russian pipeline gas into Europe. Because I think Russia looks at that also. Before the war, about 40% of Europe's gas was coming from Russia via pipeline. But since the war, we've had Russia diversify its energy supply shipments to Asian markets, fastest growing demand markets in the world. So with China specifically, you have the Power Siberia 1 that came online in 2019. That's about 3.7 BCF a day, 38 billion cubic meters a year. And since starting that, they have ramped up very quickly and are already maxing that one out. There's another plan for Power Siberia 2 to go from the northern coast area of Russia, pretty close to the Arctic, to Shanghai. And that would be about 4.8 BCF a day, 50 billion cubic meters a year. So I don't know, could see Russia just continue to diversify that.
Those two pipelines
market
are, I guess, the, sister pipelines, same general project. I think those are important to pause for a moment on, one, as you mentioned, came online in 2019. So this was not a project that was developed as a result of anything going on between Russia and Ukraine. Or maybe one would say, yes, it was, because the Russia-Ukraine conflict really started with the battle over the Crimean Peninsula back in 2014. And so somebody saw this coming and said, hey, we got to find another way. But if you just look at it in a vacuum and say, okay, well, these pipelines, they're not exactly like transiting the most hospitable, easy terrain to get through to deliver into, the large markets in China. I mean, this is, in some respects, an engineering marvel to get these done. And I think it really pairs with the concept that, we've touched on a little bit in the last couple of podcasts about the flow of Arctic LNG. So I think it bears mentioning that you got to consider whether or not Russia has found the ability to more economically extract hydrocarbons in Eastern Russia more so than Western Russia, or, whether it's economic or the idea of diversifying away from having this, what once upon a time was a very, very Western Russian development program. And so, what does it take to shift that course, right? If I've already deployed the dollars to really grow my production in the East, is there, at some price? Sure. I mean, I think that's our thesis on all things, certainly energy in our bailiwick here, but without a very clear and substantial price signal to change course. You've built the pipes, you've built the development program. Why go back the other way?
Yeah. Yeah, it's a pretty interesting one too, just with, US, EU sanctions on Russia effectively subsidizing some of that infrastructure growth and development of the new markets in Asia. So now that, we're nearing potentially the end of this war and we have the US also vying for getting more energy exports in Asia, it does raise some interesting questions there. But I think taking a closer look at the EU and what's going on with EU gas inventories and why kind of these reactions to Russian pipeline gas will potentially be creating a little bit more volatility in the next little bit. You have EU gas and storage about 34% full. It slowed down considerably in the first couple of weeks of March, withdrawal rates specifically. And now the EU's season to date, so October 1 to March 11th withdrawal, it's about 2.27, 2.28 TCF. So that's the fourth largest seasonal depletion since 2011, was trending towards the third largest for quite a while there. So what are you seeing specifically in the EU with TTF that's been interesting?
Well, I mean, I guess first comment, you brought up the slower withdrawal rate in March. Mother Nature wins once again. It's been mild in Europe, and so the withdrawal rate slows. Shocker. That's the way that it's going to go. We'll kind of come back to the concept of, warmer than normal, colder than normal. What does that even mean? But for the moment, I think the really interesting development seems to have really showed up almost within days, if not certainly a short few weeks after the announced plan to, I guess, delay water down the storage refill target. Yeah. So you saw the TTF curve get hammered pretty good. The front ran down to near $12 an MMBTU. And while there's been a healthy rebound, I think we're currently back over $13.50. The JKM market, all the while, stayed relatively steady, which opened back up what is the more normal relationship of Asian markets or JKM trading over Europe. That has not been the case essentially for the entire winter and even leading up to the winter. And it was an anomaly to us. This is a really fascinating phenomenon. And I guess maybe in some ways it was correct in that withdrawal rate, like you talked about, was alarming. And it's a risk that we've talked about, internally as a company, and certainly with plenty of our clients, the risk of even just a normal winter in Europe. What does that do without the import of piped Russian gas? And I think we've finally seen that for the first time since the Russia-Ukraine conflict. And while we're back to normal for now, I think the point you brought up earlier with volatility, not just the price levels in absolute terms or even the shape of the individual curves for TTF and JKM, but the relationship between the two. Who has to stand in front of the line saying, no, me first, I need it more than you? And when, I guess, qualifying for a moment, the comment about in a normal world, Asia should trade higher than Europe, that is simply because both markets are highly reliant on the, let's just call it 15 to 16 BCF a day of U.S. LNG exports. And it takes longer to get to Asia from the U.S. than it does to Europe.
Yeah. So transportation cost baked in. Yeah. And the other, one of the other interesting parts about the last 4 weeks in the EU for Dutch TTF in particular was the spec community's positioning. So we talked about this leading up to the pretty significant rally that TTF had over 1750. But the hedge fund positioning showed that net long interest, so long interest minus short interest, reached a multi-year high. And then since that February 11th, give or take a few days, that community has cut those positions by 57%. So the net length has fallen by 57%, 166 million contracts. And I think that really now what that looks like is maybe you'll have some of the spec community maybe slowly ease back in and evaluate kind of the near-term outlook, because while the withdrawal rates have slowed, you still have to think about what this looks like for winter 25, 26, when you're coming from the lowest aggregate inventories in quite a few years. So do you have anything on the spec community?
Yeah, chicken and the egg makes sense, right? Market got really long, market went down, market doesn't look as long. Logical conclusion. Oh, they left, they exited positions, and that's why we went back down. And if you consider the magnitude of the position reduction versus the absolute price change, it actually was not that severe a price decline. Or you could look at that from, I guess further back in the time machine and say, man, they got really long and didn't get a lot for it. We didn't really run up that much. And whichever your perspective, I think the thing going forward to be mindful of is, just like in the US, we're nearing the low point of the year for demand. So is there going to be some new development with European storage over the next 60 days or so that gets the market really excited on either side? Meaning, is it time for the bears to really step on the neck of a market that got wounded by the idea of, we're not in such a hurry to refill? Or will bulls find, the catalyst, whether it be something Russian related or some unexpected destruction of some facility or an outage somewhere? Who knows? But I think the key point, sorry, wandering a bit there, is that it may take until midsummer when demand begins to really peak again before there is a definitive direction for the European market. In other words, we got to be deep enough into the refill season to see what that pace looks like before either side will have enough conviction to put on a sizable position that is worth holding, knowing that governmental forces are at play there, probably in greater significance than anywhere else in the world.
Yeah. I think one of the daily market updates that you had around the discussion of the European Commission's gas storage mandates and potentially relaxing those was what that could mean for the months kind of trailing or leading up to the beginning of winter 25, 26. And if, say, a lot of these EU member states are choosing to delay their purchases of natural gas to refill their storage, then what does that mean for that really narrow window where you could potentially see, say, earlier cold temperatures hit Europe? And if people are significantly below that 90% refill target for November 1st, then you're going to have a pretty mad rush for refilling. So
well, I'm going to say that, just pointing out the obvious, I think the intent was that, hey, if we announce this, maybe prices will go down and it'll help to create an absolute pricing environment, but B, even, and maybe as important, a spread relationship or a shape in the TTF curve that will economically incentivize storage injections. And the opposite is true. Right now, the April contract is trading well over the January contract. So buy it today to have it later. It does not, and it doesn't mean that you don't inject, whatever the, target is, and that may change, it will get to an adequate level. I say that loosely, like adequate is maybe a subjective statement, probably shouldn't be, but it is at this moment. So the spread relationship, the shape of the TTF curve is problematic. And I guess what you're touching on there, and I think is important, is could the little bit of backwardation we see now with April trading about 50 cents over January, does that become multiple dollars? And then does that have this ripple effect across global markets of you just keep rolling the front month higher? And that's kind of tying together with the statement earlier. That may not happen in the next 30 or 60 days, but by midsummer, game on.
Yeah, absolutely. One of the points that you had earlier, I think it's appropriate to maybe come back to that. What is actually colder than normal, warmer than normal? What is even normal between EU, but also in the US? I think that's maybe a good point to pivot back to the domestic market.
So we'll just talk in U.S. terms. I think it's something that listeners are going to be more familiar with. They'll hear either from us, from many in the market, from their friends at NOAA if they still have a job, whether it was colder than normal, warmer than normal. And it's a topic I want to cover because I think there's a nuance that is not really understood as widely as maybe it should be. So when you hear discussions of whether a winter or a summer for that matter, but we'll stick with winter because we're at the tail ends of winter 24, 25 now. Has it been a normal winter, a cold winter, or a warm winter? Well, it depends on your definition of normal. And logically, one might say, well, how can the definition of normal be different? Well, it depends on the time period with which you're defining normal. In the last decade, plus maybe 3 or 4 years, there's been this gravitation in the North American natural gas market to use the 10-year normal. And for us, there is a clear risk to that. The past 10 years have been very warm. That's why the market wants to use it. I believe it's going to stay that way, global warming believer or not. So it's understandable that one might use that as their baseline. However, when you think of global weather patterns, and this is another one that troubles me and probably will until I take my last breath, on the topic of climate change, the climate does change. I mean, we all took 8th grade earth science, and there are a lot of climate changes throughout the history of this planet.
Yeah.
So it's not like
of years, it's going to change.
It's not supposed to stay the same. So if you take a longer look and you use the 30-year normal, which for us is a better data set, if there were a reliable 50 or 100-year normal, we would want to use that as the benchmark because it creates a greater sense of what can happen. And so, sorry, getting a bit down the rabbit hole here, kind of bring this back together. What's the difference? So the 10-year normal at present is the period from 2015 to 2024. And that normal is very similar to what this winter has realized at. Winter 24-25 is actually slightly colder, plus 30 HDDs, if you assume the rest of this month's forecast is accurate, versus the 10-year normal. Note that window, 2015 to 2024. So it's through last winter. The 30-year normal, its reference period is 1991 to 2020. And that normal is almost 200 HDDs colder than the 10. So key points to take away there. The obvious one, there's a big disparity between what normal is and the HDD count or the heating degree day count. But also the reference periods of the 10-year actually rolls each year. The 30-year only rolls once a decade. And when you look at the 30-year normal, this winter 24-25 is actually top 10 warm. And it fits kind of middle of the pack in the 10-year, thus near normal. And so as we move forward in time, at some point, you're going to have that 30-year capture this period. The majority of it will be 2010 to 2030. And if that proves to be, meaning the remaining few years are similarly warm, then you're going to have both a 30 and a 10-year that are incredibly warm, while full well understanding that we can get winters like 13, 14, or something like the early 80s again, and it will be absolutely jarring to a global gas market that has come to believe that it will always be a little bit warmer, particularly while we've got this mad rush to data center, crypto mine, AI ourselves into prolific demand increases. So if my baseload non-weather sensitive demand grows, all while there's this, belief that normal equals this very warm outcome, even just a year of what, at least for the time being, 1 to 2 standard deviation cold on the current 30-year would be a game changer. We haven't gotten it.
Yeah.
And so what if that 1 to 2 standard deviations on the current data set of the 30-year is applied to the new normal of the 30-year 5 years from now? It's going to look like a 3 standard deviation.
Right.
So key takeaways, I guess the key point is the 10 and the 30 are very different. One rolls yearly, one rolls every decade. And so ask the question, what normal are you using when someone tells you a period has been normal?
Yeah, it's interesting to see that bleed into the expectations and long-term forecast too. I think we were talking about that heading into this year's winter. NOAA's long-range forecast was kind of following the predictable, well, it's been warmer for the last 5 years, so this year is going to be warmer than normal. And, we saw how that was reflected in inventory expectations for the end of winter 24-25 and where reality ended up coming in. Yeah,
and speaking of, actually, and we've certainly gone back the other way. Like end of season estimates are for most that are doing some form of logical mathematical calculations is going to be 1.7 TCF, maybe even slightly higher. And so as little as a month ago, there was a lot of talk, and certainly we were part of that discussion, that we could be tracking to 1.5 TCF or lower. So why is that? Well, the month of March is going to go in the books substantially warmer than most Marches in the last 50 years, even warmer than March of 24, and we will have lost about 100 HDDs versus, again, what we believe to be the more appropriate measure, the 30-year normal. Minus 100 HDDs is about 200 BCF of demand. 1.7 minus 200 equals 1.5 TCF. And here we are. So Mother Nature wins, much like Europe.
Yeah.
Same thing here. End of seasons have gravitated higher. And, I think there's been a fitting price response too. For us in the last 10 days, it's been pretty surprising to see how resilient the front of the NYMEX natural gas curve had been. And yet here we are on Friday, March 14th, and we're hovering right around the $4 mark, about 65 cents lower than we were trading in intraday highs earlier this week. And while the curve is still backwardated, meaning, the balance of 25 is still over Cal 26, that margin is far narrower. We're looking at a 7-cent spread right now. So you flatten the curve back out, and there are some really interesting dynamics won't get into it on this podcast, but just in the shape of, say, one Cal strip versus the next relative to more spec-driven season-to-season spreads. Be maybe a good topic for next week. April, October, or October, January spreads. They have a little bit of a different, signal being sent than the kind of bigger, producer-consumer vantage point of where's this Cal strip trading versus the next one.
Yeah. Yeah. One of the One of the points that we talked about last week on the Chuck Yates Needs a Job podcast, by the way, if you guys have not listened to that, had a lot of fun down recording with Chuck, had some really interesting conversations about kind of AI, nuclear, all things demand and opportunities for the natural gas industry. But one of the points that we discussed was some of the pipeline regulatory landscape that's been an issue for, the last 5 or so years and how that maybe changes under Trump 2.0. But yesterday, news of President Trump going to New York to talk to Governor Kathy Hochul to potentially revive the Constitution natural gas pipeline. I think you had a comment about that in the podcast, if I'm remembering correctly. You have any thoughts that you can add on that and what that would maybe mean for the Northeast?
Yeah, first, I'm just going to second what you said. Anybody that listens to this one, it's worth your time. That was a great one with Chuck Yates. So please go give it a listen on your drive, on your train trip, on your plane trip. Yeah, I think there's maybe a reality versus a dream. So President Trump, I believe, even in his first address to Congress, brought this pipeline up and we're going to get this huge pipeline done and we're going to get it done faster than anybody thinks, suggesting it would be done in 9 months. And so I think in today's terms, it's actually not huge. It's a the pipeline that at the time it was initially conceived of at about 0.65 BCF a day was large. In today's world where we frequently build 2.5 BCF a day pipes, it doesn't seem so big. It is and would be a vital path to get MMBTUs into a market that can price at some of the highest levels of anywhere in the country, meaning the, New York, New Jersey metro areas. The utilities there would certainly welcome the flow of some Appalachian gas. And so the intended path was to take northeastern PA, core Marcellus production. It was a pipeline originally backed by Cabot, now Coterra, AltaGas, and I'm going to draw a blank on the other utilities. There were some utilities involved. And it wasn't the only pipe that ran into regulatory hurdles, local opposition. There was another even larger pipeline, the Penn East project. And so could either of these, and right now President Trump's really working to drum up some support for the Constitution pipeline, it would be a great thing for the consumers in the state of New York. But there's another interesting, storyline that sits in the background. It's even better for the producer in northeastern PA. If we were really about helping the consumers in New York, there are significant gas reserves just across the border. And so why wouldn't the state of New York revisit its ban on fracking, develop its own natural resources, build its own pipeline, generate more tax dollars from the E&P community, serve the demand just as efficiently as Constitution could? The answer is NIMBY. If we want it from somewhere else, they did it, even though it's right across this imaginary line that goes through a forest somewhere. Will it get done? I think probably in the 9 to 12 months that President Trump proposed, I would say snowball chance in hell.
Yeah.
But, I think first is if anybody tracking it, I think the thing to look for is, of course, utilities behind it. Williams, the number one backer, the pipeline developer. So do you see Williams or Coterra make any public comments about this pipeline and resurrecting the flow of gas from northeastern PA towards New York metro areas? Yeah.
Well, it'll be interesting to see. Maybe that's kind of an early signal for what other infrastructure we can maybe expect to revitalize or see come online. Do you want to dig into OPEC this week, or do you want to push that to next week?
Why don't you do the quick highlights? I think it's a good it's present. Let's throw it out there now, and maybe we can take a deeper dive next week. Talk about some individual members.
Yeah, I think the kind of high level summary is the February production numbers released with March's MOMER showed core OPEC increased production by about 154,000 barrels per day to just under 26.9 million barrels per day, so 26.86. Interestingly, core OPEC increase, as I said, 154,000. OPEC plus, so all of the Declaration of Cooperation participants produced an average of 41.01 million in February, million barrels per day. So that was up 363,000. And so I think that's really those two numbers, 363,000 and 154,000, is kind of the ones to focus on for right now, given OPEC plus is targeting 138,000 barrel per day increase in April as they start to unwind production cuts. So we've already outstripped that by 2.6x. So I think the kind of long brewing compliance issues that have been hitting the Declaration of Cooperation participants, you really have, Kazakhstan, UAE, and a few others that have been persistent on their overproduction. I think there's a little bit of that exasperation maybe starting to bleed through. And what that means for March, I suspect that you'd see a little bit more of that early creep ahead of schedule. And, as a, knock-on effect, you're just questioning the significance of April's unwind. Will that be an additional 138,000 that they relax on top of the 363,000 that's already here? Or, what are your thoughts?
Yeah, I think you hit the nail on the head. 150,000 or less is not a big number. But if you went up 500,000 before you started increasing very ratably every month, 150 or so, then it's a very different argument. Yeah. I think in general, just the theme is that OPEC seems to be reconsidering its role as the global market police and trying to support prices, and is, kind of passing the baton and saying, okay, North America, your turn. We've been hovering very near, the price level. We actually wrote about it this week. You look at a price chart of front month WTI and make your head spin how many times we've bounced off of $67 a barrel in the past 3 years. And the general narrative for the North American market is that North American production will not be sustainable, meaning it will not be able to hold flat and certainly will not be able to show any material sequential growth at 65 or lower. So here we are. OPEC's making this decision to raise. Looks like they've already raised before that. Next week, we can cover some of the individual members and their behavior. But the two competing numbers, there is the 65, kind of mythical unicorn for the U.S., but maybe North America in general. And then there's this OPEC number that often still gets floated, that OPEC doesn't work at $85 or less. That was first screamed from the mountaintops in 2014. And anybody that's been doing this oil, gas, markety thing since then is well aware of what happened between the U.S. shale producer and OPEC back then. And here we are at present, and that number will still get thrown out there. When in reality, if you look at the span of time, even going back before the U.S. shale Saudi price war, the average price of front month Brent, just the average daily close, not to say that that's, what price they receive. Obviously, there are the OSPs, there are different pricing mechanisms, but the average price is $69 a barrel. So not a whole lot different than the 65 that we talk about here. And lo and behold, guess where the front of the Brent curve is? About $69 a barrel. So I think we're in this kind of great unknown of, all right, where do we go from here? Is the supply side moving higher? And is the market ready for it to move higher? And, maybe we'll just leave that on the table for next week's discussion too. Certainly we'll cover it with our clients and, even wrote about it yesterday in our daily report. But what happens with sequential demand in changes historically, I think will be another interesting topic to add to next week's list.
Yeah. The demand cliffhanger. Yeah, there's a lot of that, especially as I think I'm hearing a lot more recession commentary, recession concerns in the U.S. and outside of the U.S. as well. But I think there's maybe some interesting points to dig into there for hiring trends and others. Already done a little bit of analysis. So we should definitely talk about that next week.
All right. I think we did it.
All right.
Good discussion.
I'll catch you next Friday.
All right. Sounds good. See you, Alex.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.